continue with globalization and free trade. And this will be part B, which will be graphs. And so we're going to look at this like an economist would look at it. Now, you're going to need to get a piece of paper and redraw these graphs on your own. You can't just look at the pictures in here and expect to get it. You're going to have to stop and start this lecture quite a few times so you can draw these graphs. If you're having issues with it, just let me know one way or another. All right, so Trade Politics 101, the case against free trade. It's jobs. Simple as that. Producers count more than consumers because producers put people to work. Labor unions also push for protectionism because it protects these workers. And it's the consumer that bears the cost. But consumers are disorganized and typically and not, we're 350 million people in the U.S. and it's hard to get ourselves together, whereas a labor union or a producer, they can organize and lobby Congress for protectionism against free trade from other countries, right? And protectionism is going to reduce our ability to create value through trade. We're going to leave money on the table. And what we're trying to do with protectionism is isolate industries so they don't have to reduce their costs by competing on the global market. So here domestically, if we pay for something made in the USA, it might be a little more expensive given labor. And you say, well, but that's a better deal for America. Well, it is for producers, but it isn't for consumers because now you've just spent 10% more on product X that you could have spent on product Y. Maybe that's what you want to do. Maybe it isn't. But typically protectionist countries, ones that build up these walls against trade, they're less productive and ultimately poor, without a doubt. History has shown us that. I mean, Fort Wyoming, if we just had to eat what we grew in Wyoming, as we said before, that would be an issue. All right, so we're going to use this series of graphs to show how value is created by free trade and how a tariff or a tax to reduce free trade reduces economic efficiency. So if we consider autarky, which is what you call no trade between two countries, and we're going to focus in on the US and China. Suppose we're trading tennis shoes. As you can see by this graph, we'd have two supply and demand graphs, two markets, one domestic US, one domestic China. There are two different prices, the price in the US and the price in China, two different quantities. And they're based on the supply curve in the US and the supply curve in China and the demand curves. And looking at the US case, you can see the supply curve is relatively steep, which means producing that's relatively expensive. And we can see there's quite a bit of demand. In China, the supply curve is relatively flat, which means it's cheaper. And let's say there's less demand. So the price, and we're going to measure everything in dollars just so we have equivalency across the two countries. We're going to see the price in the US is a lot higher than the price in China. So it's like a series of locks between the Great Lakes. The water in Lake Superior is higher than the water in Lake Michigan. And in order to get from Lake Michigan to Lake Superior, you're going to need a lock system that levels out the water. Well, that's the idea of free trade. Once you introduce free trade, things will change. But as you can see, areas A and B represent consumer and producer surplus in the US. That triangle there is total gains from exchange in the US only. And C and D represent the two areas of consumer and producer surplus in China. Again, that represents the value created by trade in just China. All right, and so, again, that's just repeating what I just said. Now, if we have free trade of shoes, imports in the US, and China exports, what's going to happen is a world price is going to emerge, right? So you take the supply curves from both countries and put them together, and the demand curves from both countries, put them together, and you're going to end up with a world price that falls in between the US price and the Chinese price. It's going to be lower in the US, it's going to be higher in China. So what you end up then with is the US demanding more out here at this world price than can be supplied in the US at this price back here. China now is going to be wanting to supply this product by more than people are willing to demand in China at the higher price. And so now you have the perfect case of China producing more, the US demanding more, so the US is going to import this good from China. Okay. All right, this world price again. How does it come about? You take the two supply curves, add them up, take the two demand curves, add them up. That price is going to be a weighted average of the price of the two countries based on relative supply and demand, and it's going to fall in between. If you draw this graph and the world price doesn't fall in between the higher US price and the lower Chinese price, draw it again because you drew it incorrectly. Now, so win-win. China producers are happy. U.S. consumers are happy. Prices are lower for the identical product for U.S. consumers. Prices are higher for the identical product for Chinese producers. It's win-win. That's the definition of it. Is both countries are happy. There's the imports right here, and there's the exports right here. And we're assuming they're equal. There's just a bilateral trade, even though my drawing is not perfect. Imports are going to equal exports in this example. And the exports are going to go here. So this little bit in China represents sales in the domestic market. This represents exports to the U.S. market. This little bit here represents, excuse me, production in the U.S. market, and this represents imports in the U.S. market because we're going to demand all this now given the price has fallen. Okay, so imports equal exports in this basic country. China domestic production increases and U.S. domestic production decreases. And this is where the rub comes in because now that production decrease means jobs in that industry are going down. The people in that industry got to find something else to do. And if transitions are easy, they can find a substitute. You know, let's say they're a truck driver and for company A, they can go be a truck driver for company B. But if their skills are very specialized, then there's an issue here. So this idea of domestic production decreasing is where the politics comes in because now we're talking about people losing their jobs. And politicians hate that. Economists can sort of poo-poo it as just being part of the transition, but politicians can't poo-poo it because those people are voters. All right, so let's actually look at where the gains from trade are. So before in the U.S. we had this this triangle over here, A and B. These what we had marked off. Now what happens is we add this extra triangle right to the hashed mark there, or excuse me, it is the hashed triangle. So we have one triangle plus a second triangle. That is the gains from trade that goes strictly to U.S. consumers because they were able to buy more at a lower price. There's still producer surplus, but now it's just that small triangle way to the left. In China, the exact opposite story. Now producer surplus goes way up because now they can sell at a higher price. And so they get more money from both the domestic, or more surplus from both the domestic market and from exports. And consumer surplus for the Chinese goes down, but that's just a transfer. So it's these two hashed areas that represent gains from trade and why 99% of all economists say free trade is a good idea, because we're picking up those two hashed areas by opening up trade between China and the United States. This bilateral deal, trade liberalization, we've gained all this extra value because we've opened up trade. right? The red hashed area in the US, all gains go to consumers. Red hashed area in China, all gains go to producers, right? And note there's a transfer of surplus from producers to consumers in the US. And like just the opposite, there's a transfer of surplus from consumers to producers in China. Okay, so the US producers are winners win in both countries. Consumers gain in US, Chinese producers gain in China due to these exports and imports. But the domestic industry shrinks. People are let go. Jobs are lost. Unemployment goes up in this industry. Retooling and relearning a new skill, right? The long run effect is kids in these families don't necessarily follow in their family's footsteps anymore because those jobs are gone. Just like I come from a long line of lumberjacks, and as those jobs disappeared due to machinery, ended up being a college professor, right? So I mean, lumberjacking is not necessarily my thing anymore, even though cutting trees is great. So it's a good thing in the long run as people find better jobs, people go back to school, people don't think about the old industry. Again, this is cold-blooded economics here. All right. Trade Politics 101. Producers count more than consumers. So looking at this graph, we have our imports and we have our exports. And we have to go up into the U.S. market, and we see that shrinkage in the U.S. domestic industry producing the quantity of the goods. Now they produce less. U.S. producers cut back, industries go down, and they are going to scream bloody murder and push for protectionism and push for, let's say in this case, tariffs, a tax on whatever is traded, so that the world price that comes to the United States then gets a tax added onto it so that domestic production can be more competitive. So a tariff is another word for a tax. So, a lot of people who support Trump are not for higher taxes, but they're for tariffs, which doesn't make sense. If you're not for higher taxes, you can't be for tariffs because tariffs is just a higher tax. So I suppose it depends on what you're trying to tax, right? So a tariff is a tax placed on imported goods as the good arrives at the border of the importing country. So what happens if we put a tariff on? Well, we get more domestic production, good for jobs. We get higher prices, that's bad for consumers. It's also bad for the Chinese producers because now the demand goes down in the US, and so there's less to export. And there's also deadweight loss. We're going to leave money on the table, or we're essentially burning dollar bills because we are artificially restricting trade with this tariff. If we let trade go, we saw the gains from trade. If we put the tariff on artificially in the sense of trying to protect jobs, it's essentially the same as leaving money on the table or just burning dollar bills because there's money there to be had and we don't want it. So here is what happens when you add the tariff. As you can see, the tariff raises the world price. That PW plus T, that's the tariff. That's the tax per unit imported. So what happens now? What happens is we see the price line shift up above the world price. And so now the imports actually shrink and domestic production increases. So exports shrink, imports shrink, domestic U.S. production increases. So you say, is that good? Well, yes and no. I mean, it's good if you're only measuring jobs. It's bad if you're measuring economic welfare. Okay, why is that? Well, let's focus in on the U.S. and the tariff. So that tariff pushed world prices up, and now it divides that gains from trade into 4 sections. All right. So we can see imports without the tariff were pretty big. Imports with the tariff are smaller. So you can see this dotted line, this dot and this dot represent imports without a tariff. This dot and this dot represent imports with a tariff. Now there are 4 different areas that we want to consider here. Area 1 is the remaining consumer surplus. So that is the surplus we get from importing something at a higher price. So we still gain that. Area 2 and 3 are both deadweight losses. Nobody gets that. That is just gone. Money gone from the table. Producers don't get it. Consumers don't get that surplus. Nobody gets it. It's gone. And Area 4 is the government revenue from the tariff, because that represents the level of inputs times T. That difference here between these two values is T, so that represents money that goes to the government, which may get wasted, may be inefficient, maybe they'll do great things with it, who knows. But that's money that leaves the consumer's pocketbook and goes straight to the government. So if you're a small government person, again, putting tariffs on just means bigger government because you're giving them more revenue. So by putting on a tariff, I don't want to say you're shooting yourself in the foot, but you're shooting yourself in the foot. You're saying, well, we want more domestic jobs, and the way to get more domestic jobs is to make the consumer pay more, and by then sending also money to the government in forms of revenue from this tariff. All right? Again, we look at those 4 areas. Consumer surplus remaining, the 2 deadweight losses that go to nobody, that's just burning money, and then government revenue right here, number 4. So the tariff raises domestic prices, imports go down, domestic production goes up. Overall net gains from trade go away. All you've got is basically Area 1 now. And then Area 4 represents revenue that may or may not be spent wisely depending on what the government is doing. Win-win under tariff is now more like sort of win-win. I mean, consumer win decreases because, as I said, consumers pay more. Increased domestic production is not a win in terms of the welfare. It's just a transfer of surplus from producers to consumers. Jobs would be considered the win. Deadweight loss is definitely a loss. Revenue going to the government depends on your view of government, whether that's going to be wasted or not. The China win decreases too because now producers have a smaller export market, and consumers in China are now paying more because of world price. So China still has a win, but it's not as good as a win. The U.S. still has a win, but it's not as good a win if they're under the world of no tariffs. So free trade good, tariffs bad. I mean, that's the caveman way of saying what an economist would say. I mean, most economists think this way, right? I mean, tariffs impose costs on the country that sets them. And tariffs also invite foreigners to respond with their own retaliatory tariffs, which are going to hurt our exporters. New tariffs that break past promises are also going to undercut trust. You can act like a tough guy, but definitely our trust between each other is gone, and now, that could hurt other negotiations that go on. Tariffs distort the economy, which may very well reduce productivity, because now we're trying to keep alive an industry that was otherwise on its last legs, perhaps. Could be done cheaper elsewhere, and we're trying to prop it up, and now we're sending resources to prop up an industry that should be allowed to go away. And we should be focusing our energy on being more productive in another industry. Like instead of propping up coal, we should be propping up coal as carbon-based products that we can make cars out of or highways out of, instead of using coal just to burn. So there's that issue. And I mean, there's no doubt that the American steel companies were happy with the tariff put on imported steel. But the people who have to buy steel, they're not going to be happy. So, yeah, you made the steel manufacturers happy, who are a well-organized group, but all the people who buy steel, they're not happy. But they're just not as organized, and they can't complain the same way that the producers can. All right, so draw this graph, redraw this graph, because I know you're going to see this. You're going to have to do it for me on a quiz. No doubt about that. All right, let me know if you got any questions.